Hi all, Raj here, hope you're all well. Different types of interest rates and what do they mean? So the different types out there predominantly are fixed rate, tracker rate, there is also something called a discount rate, and one thing I'll come on to then is something called a standard variable rate, but that's not something you can normally get up front. I'll explain later. Fixed rate, this means that the interest rate that you are charged by the lender is fixed for a certain length of time. How long? Typically between minimum 2 years and usually up to maximum of 5 years. There are some exceptions with that going, some lenders will go a bit beyond that, but it's very few and far between. You can do it for 3 and 4 years, but again, you hardly ever see any 4-year ones, because they tend just to be 5-year ones. One thing you need to understand is the longer you fix it for, the higher the interest rate will be, and that'll be from day one. So for example, if you did a 2-year fixed, that's going to be cheaper than a 5-year fixed. A 5-year fixed will be more expensive from day one, not just say after 2 years. The other one that I mentioned was tracker rate. So tracker typically tracks the Bank of England base rate. What does that mean? The Bank of England is a central bank and they set the interest rates for when they lend to other banks. They call it a base rate, and that's the rate they work off. That has a massive effect on all other interest rates, including savings, including credit cards, personal loans, and of course mortgages. It's the most important rate, I would say, in the UK. And the way it works is, say for example, at the moment the Bank of England base rate is 0.1%. So the lender offers you 1% above the base, so that's 1.1%. That's the interest you pay. However, the Bank of England meet once every month, and if they decide to change the interest rates, let's say they decide to move it up 1%, that's your interest rate on your mortgage would go up 1% as well, meaning your interest rate is now 2.1%. So that can literally change in a moment. Your next payment would increase. So that's the risk with a tracker mortgage. The benefit of a tracker mortgage would be if you thought interest rates were going to go down, and then you can benefit from the decrease in interest rates. Fixed rate, I forgot to mention, the benefit of it is you can budget monthly. You're protected against interest rate rises. However, if interest rates decrease, you can't get that benefit because you're locked in. Another type of interest rate is a discount rate. You don't get many of these. Each lender has something called their own standard rate, and it's very similar to a tracker rate as a discount. It just means it kind of tracks the lender's standard rate, and as it suggests, it discounts. So if the lender's standard rate, or standard available rate as it's known, will say 5%, and you've got a discount of 3%, that means your interest rate is 2%. If obviously they change their rate, your rate changes with it. So it has similarities. It's variable in the sense that tracker it's not fixed. If you want any more information or you're not sure, if you want any more information from myself, please do get in touch and message me, and I'm more than happy to help if you need some advice. Thank you, and thanks for listening.